So you did it. You hit a major retirement savings goal. And first off, I just have to say, congratulations. Seriously, that is a huge accomplishment. But, it can also bring up this nagging question, right? I've built this solid nest egg. So what in the world am I supposed to do now? Well, let's dive into that. $300,000. Just let that number sink in for a moment. Hitting this six-figure mark in your retirement account, well, that's not just another birthday. It's the result of years of discipline, of consistently putting money away and making smart choices. It's a real testament to your hard work, and you should be incredibly proud. And this is the exact question someone asked me recently right after they hit that number. It's so simple, so direct, and it's the question that really signals a shift. You see, the hard work of just saving got you to this point, but it's the work of strategizing that's going to carry you over the finish line. If that's exactly right, you're at a critical juncture. I kind of like to think of it as reaching a high base camp on a mountain. The air's a little thinner up here, The decisions you make now have this outsized impact on whether you successfully make it to the summit of a secure retirement. The stakes are higher, for sure, but so are the opportunities. So, what is it about this $300,000 mark that makes it such a turning point? Well, it all comes down to one of the most powerful, almost magical forces in finance, compounding. This is the moment where your money truly starts working for you, building on itself. And this slide just visualizes that tipping point perfectly. For years, it probably felt like your contributions, that's the smaller bar on the left, were doing all the heavy lifting. But as you can see, right around this savings level, you'll start having these amazing years where the market's growth, that bigger bar, actually adds more to your balance than you did. Have you started to notice that in your own accounts? That feeling is the magic of compounding in action. Okay, so you have this powerful, growing asset. Now, let's get practical. The very first thing you need to focus on isn't a specific investment or a stock tip. It's your time horizon. Before you can make any other decision, you have to know how much time you have until you plan to retire. This timeline illustrates the idea brilliantly. Someone who is at today with, say, decades to go can afford to be more aggressive, maybe with a higher chunk in stocks. But as you move along this line and get closer, say you're at 5 years to retirement, whoa, the game changes. You'll want to start preserving that capital, which means your investment mix should thoughtfully adapt, probably shifting more towards bonds. So how do you actually do that? Well, it starts with a really clear-eyed assessment of where you are. This means doing a risk assessment to understand your comfort with the market's ups and downs, and then determining the right asset allocation for you. And honestly, this is the point where seriously considering professional advice can pay off big time. Because the crucial takeaway here is that there is no one-size-fits-all approach. What worked for your neighbor could be totally wrong for you. Okay, once you've defined your time horizon, the next crucial step is building a thoughtful diversification strategy. As your account gets bigger, making sure your eggs aren't all in one basket becomes absolutely paramount. It goes from a good idea to a must-do. Now, this is a really common trap. It is so easy to pile up a lot of your own company's stock through things like employee stock purchase plans. But having too much of your net worth tied to your employer's fate is a huge, often overlooked risk. The goal is to move from that risky concentration to a coordinated, intentionally diversified portfolio. This brings us to a key term you really need to know: unintended concentration risk. This one is sneaky. It's what happens when you think you're diversified because you own, an S&P 500 fund and a growth fund. But then you look under the hood and realize both are heavily weighted towards the exact same handful of mega-cap tech stocks. You're not nearly as safe as you thought you were. I absolutely love this analogy, the buffet problem. You know how it is. You go to a buffet, you grab a little of this, a little of that. It feels like you're getting all this variety, but there's no real plan. You might get back to your table and realize you've got 3 different kinds of potato dishes. That's what can happen in your portfolio without a coordinated strategy, and it leads to those risky overlaps. All right, on to our final strategic pillar, taxes. With a larger balance, smart tax planning shifts from being something that's just nice to have to being an absolutely essential part of keeping more of your hard-earned money. And the core of your tax planning really revolves around this choice. With pre-tax accounts, like a traditional 401k, you get a tax break now, but you pay taxes when you take the money out in retirement. With Roth accounts, it's the opposite. You pay the taxes now, and then your qualified withdrawals in retirement are completely tax-free. Understanding this difference is just key. This, of course, leads to the big question. Should you convert some of that pre-tax money to a Roth? The answer is really a strategic bet on your future self. You have to ask, do you expect to be in a higher or lower tax bracket in retirement than you are today? If you think your income, and therefore your taxes, will be higher later, paying the tax now at a lower rate could be a very, very smart move. So the ideal strategy for most people is to build a mix that gives you options. First, you use your traditional 401k, especially to get that valuable employer match. That's free money. Then you explore Roth options for that powerful tax-free growth. And finally, you can build a regular taxable brokerage account for maximum flexibility. Having all three gives you incredible control over your tax bill in retirement. So let's just step back and look at the big picture here. You've done the incredible work of saving and accumulating. You've reached that inflection point where the whole game of wealth building starts to change in your favor. But now, your focus really has to shift. This quote from the source material just says it all perfectly. Hitting $300,000 is this signal that your mindset needs to evolve. It's no longer just about how much you can put away each month. It's about making that money work as intelligently and efficiently as possible through a smart strategy.
And that's the thought I really want to leave you with. You should be incredibly proud of reaching this milestone. The same discipline that got you here is absolutely going to carry you forward. But now is the time to ask, is your strategy for your time horizon, your diversification, and your taxes, is it ready to take you to the next milestone and the one after that?